Retirement may seem far away from now, but it is never too early to start preparing. Planning retirement needs to factor in how much you earn over the years and also need to evaluate the potential of how much passive income your investment can generate in the near future. One standout option in this field is the Schwab U.S. Dividend Equity ETF, or SCHD. It is an excellent choice for earning passive income after you retire. In this video, we will find out how much SCHD we can comfortably retire and what are the possible factors you need to consider. At the end, we will find out how much we need to invest in SCHD to retire now versus 10, 20, and 30 years. Now, let's see what exactly SCHD is. It is short for Schwab U.S. Dividend Equity ETF. This is an exchange-traded fund offered by Charles Schwab. When you own SCHD, it is like having a diverse portfolio of stocks that pay solid dividends, a share of a company's profits given to shareholders. We can understand it as a one-stop shop for dividend stocks. You don't need to worry about buying Coca-Cola or PepsiCo, Pfizer or AbbVie. They are all there for you. These companies tend to have a strong financial history and can weather economic challenges, allowing them to keep paying dividends consistently. For dividend investors, the goal is to have reliable payouts, especially in challenging market conditions. Currently, SCHD holds 104 stocks to mirror the performance of Dow Jones U.S. Dividend 100 Index, which is designated to measure the performance of high dividend stocks in the U.S. with a consistent dividend track record. Now, let's take a closer look at SCHD. Usually, stocks are either high growth or pay good dividends. But SCHD can do both by selecting companies based on financial health and dividend history. We know that inflation is happening in most years, so receiving the same amount of dividend every year means we are losing purchasing power. It would be nice to receive more dividends every year to catch up with inflation. If you look at the performance against the S&P 500, also known as the market, you will see SCHD is positively correlated to the market. In some years, SCHD even beat the market. How about the dividend growth rate? In the last 3 years, the dividend growth rate is 8.56% per year. The last 5 years is 11.80%, and the last 10 years is 10.87%. How about the S&P 500? They are 6.51% for the last 3 years, 5.12% for the last 5 years, and 6.80% for the last 10 years. We can see SCHD pays better dividends than the S&P 500. In the past 10 years, the inflation rate is about 3% per year. So, SCHD is actually paying more dividends every year to beat the inflation. For retirees counting on passive income, owning SCHD means gaining purchasing power every year. That's more money into your pocket. Some of the top holdings are Chevron, Lockheed Martin, Texas Instrument, PepsiCo, and United Parcel Service. Each of them is a giant in their respective industry, like energy, defense, technology, consumer staples, and industrials. Each investment has its own risks. SCHD is the same. The good thing about SCHD is they offer a combination of stocks in various sectors with excellent dividend history and potential growth. However, the risk is existing. There are so many factors that could influence the index, so the price can go up and down just like the market. Some of the companies may have financial difficulties paying dividends, but the chance of all companies not being able to pay dividends is very low. Every year, SCHD replaces underperformed companies with ones that meet the selection criteria. Now we know what SCHD is and how it works. Let's see how much we need to invest in it. This could be different for everyone, but we can still sketch out a general timeline. Based on your situation, you will figure out where you are in the initial investment. One important factor to keep in mind is inflation. Inflation is most likely to happen in the long run, as prices will continue to rise. So it will cost us more to keep the same lifestyle. Also, with longer life expectancies, plan for at least 2 decades or more in retirement needing passive income. Starting early gives you a significant advantage, allowing your investments to grow over time. By planning ahead and regularly investing in SCHD, you can build a portfolio that generates enough dividend income to cover your expenses and support your desired lifestyle throughout retirement. The average monthly expenses for an adult in the U.S. is about $3,000 per month. This is $36,000 per year. Based on the inflation data in the past 10 years, the average inflation rate is at 3%. As time goes, you will need more money to keep the same quality of life. So 10 years from now, $3,000 per month today would become $4,032 per month. 20 years from now, it would be $5,418. And 30 years from now, it would be $7,282 to live comfortably. Now, let's see what SCHD's performance has been in the last 10 years, then we can determine how much we need to invest. We evaluate the performance based on the dividend yield, dividend growth rate, and average share price appreciation. The current dividend yield is 3.48%. The dividend growth rate is 10.87% per year in the past 10 years. And the average share price appreciation is 9.29% per year. How much do we need to invest? That should be based upon how far you are from retirement. Now? 10 years from now? 20 years from now? Or 30 years from now? The amount of money you need to invest for each time period is drastically different. Dividend yield and dividend growth are playing significant roles in this investment as well. If you choose to reinvest dividends and let it compound over time, then your initial investment would be much smaller. Later on in the investment, the compounding effect will accelerate the growth of your portfolio. If you want to retire now, you would need $1,034,483. This is a huge amount for most investors, so it is not achievable in the near future, especially for those working 9 to 5. How about retire in 10 years? You would need $4,032 per month as passive income. This is good for people who are in their 50s. It could be in any other circumstance. The amount you would need to invest in SCHD is $400,000. This is a lot better than retiring immediately with $1 million. Leveraging time and compounding can greatly reduce the amount that is required for investment. Still, $400,000 is not a small amount, so it could be hard for people in their 50s or any other ages. How about retire in 20 years? At this point, you would need $5,418 per month after factoring in inflation. Now the initial investment has been greatly reduced to $130,000. For people in their 30s and 40s, this amount may still be a lot, but it is achievable within years. That's why Charlie Munger said the first $100,000 is the hardest. 20 years is a long time for investment to grow and have more to do for compounding to maximize your initial investment. How about making the same amount with a more affordable initial investment? Of course, that would take us more time, but less input. For 30 years, we would need $7,282 to retire. For your initial investment to compound over 30 years, you only need to invest $39,000 to get there. This amount is absolutely doable for anyone in their 20s or 30s. In this plan, you may not need a big initial investment, but you do need more patience. The first 10 years would have a very slow growth compared to the second 10 years. As long as you are not giving up, your patience will pay off. Retiring from SCHD is not a dream. Given enough time and patience, it will not take you a lot to get there. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.